wave your hands. All right. Just say hi. All right. So that I know that you can hear me loud and clear. Okay, we've got a decent number of people coming in. So looks good. We're gonna start at 7:30 sharp. Okay. And okay, while you're at it, for the people who are familiar with what I do, I use this tool called mentimeter.com. So go to www.menti.com and then use the code 32954873, and we're going to have a short, very, very short kind of interaction before we begin, all right? Because we don't have a very long session today. And I'm feeling kind of happy because no sales pressure. Okay. Yeah. So basically it's just making sure that we'll be able to have a fun session today. And the material today is quite hard, all right, for members of the public. So it's very experimental. So I think that's exactly how I like my sessions to be. All right. We're stretching the envelope to see how far we can go. All right, to make this a successful event. All right. Let's see. Okay. All right, let's just wait for the rest to come in. All right, 5 more minutes and then we will start. Okay, for the folks who have already come in, I normally conduct an icebreaker. So to do that, you can open a new tab on your browser, go to www.menti.com, use the code 32954873, and we'll be having a little bit of fun, doing a little bit of surveys, friendly surveys, so that we'll get to find out who's actually attending our seminar for today, all right? So it shouldn't be a big crowd, okay, because in my community this is going to be recorded for them, so most of them will be waiting for the video to come out later on. All right, so but for those guys who are here, all right, we could play, all right, and you can participate in our survey, all right, by going to menti.com. Okay, so use the code and then go in and then click on the bottom right hand corner. You see heart, so that I know that there'll be some of you who are actually interacting with me on this page. All right, we should have some people interacting if to run this survey. Okay, so if there's 10 or more, then what I'll do is I'll run it. You know, otherwise we don't reach critical mass. Okay, sometimes it happens, right? We don't reach critical mass, and then we can't actually conduct this survey. All right, yeah. Okay, we will start in 2 minutes time. If you're looking at the screen now, there is a way for me to interact with the audience that's already here. So go to www.menti.com and use the code 32954873, and we'll be able to get yourselves involved in our icebreaker session. All right, it should be fun. Once you get in, click on the bottom right-hand corner with the heart so that I know that there are a number of people who are participating in this particular program. All right, don't worry, the data will not, we don't collect your personal data. All right, so absolutely nothing to worry about. Okay, it is 7:30 p.m. and I'm about to start. All right, so one more time, one last time. All right, risk of sounding like a broken record. You can interact with me by going to www.menti.com on a separate browser and keying in the code 32954873. All right, once you're in, just click the heart at the bottom right hand corner so that I know that we're coming in to just play, to see whether we can get to know the people that are dialed in today. All right, so we've got about 32 participants. Typically about maybe 1/3 of them would actually participate, all right, in the survey. Okay, and let's just quickly go through that before we begin tonight's session. Okay, all righty, so let's go. Okay, so before I begin, right, remember that this is for educational reasons. That's why we're here. So when I make references to investment securities, they're not a buy or sell recommendation to you. And today is particularly important because I will be actually mentioning a name of a couple of stocks which I intend to buy for myself. All right, so they are not a buy or sell recommendation for you guys. All right, and because of that, Dr. Wealth and myself, we are not liable for the losses if it is caused by any material in these notes. Okay. Okay, so for the guys in the general public, you're not sure who I am. I'm Christopher Ng. I retired at the age of 39 with a 6-figure dividend income portfolio. And previously, I passed 3 levels of the CFA exam. And I've been featured on the Straits Times a couple of times. And I'm also the author of a best-selling book, but that's many years ago, right? About 16 years ago. And right now, I'm a trainer for the Dr. Wealth's Early Retirement Masterclass, where I show my students how to retire early. And I think, first of all, let's try to get to know you guys a little bit better. All right. So for the people who are actually logged in, I just want to find out whether you are alumni attending the program or you're a curious member of the public. Okay. So for the alumni attending the program, I don't expect a lot of them. All right, because it is somewhat recorded, although there will be a Q&A that they can interact with me. Okay. So wow, it's pretty cool. So we got about 50-50 after about 10 responses. All right. So actually today's session, we've actually got more or less an equal amount of alumni. Okay, all right. Okay, so let's quickly move on to the next slide. So let me know what your profession is so that when you key it in, we will see the kinds of people that are interacting with me in this session. Okay, well, we've got a CPA, all right, engineer, egg-slut. I did try to queue up for egg-slut a couple of days ago, but the queue was simply too long. And I gave up and I end up eating somewhere else. And when I was eating at the mala place that I normally go to, they were talking about egg-slut, and they said that the other day somebody fainted queuing up for an egg sandwich, right? So yeah, I can see how ridiculous this egg-slut idea is. So I don't know who this person is. Maybe he works for egg-slut. Okay, it's probably the hottest restaurant that you have right now. Okay, yeah, there's a $23 Wagyu beef sandwich that I probably will buy if I could go in. We also have a financial independence dreamer. Okay, in my program in ERM, we don't dream about it. We actually take concrete steps to actually become financially independent. Okay, if you're a member of the public, then you get to see from a very broad helicopter view how we actually do this. All right, today. Okay, all right. Okay, so 14 people have replied. Okay, more people have coming in to participate in our survey. Okay, all right, and let me just continue with my next question. Okay, this is very important. Okay, and this sort of measures how bullish or bearish you are with the Singapore markets right now. Okay, so what is your current stance? Are you bullish? Do you think that the market rally has begun? Or you think that the STI will retrace to lower lows? Okay, and this is very important because this is some way for us to just assess, generally speaking, how people are feeling about the financial markets right now. Okay, and very interestingly, if you see more people answer bearish, right? Yeah, it sort of reflects the mood and the tone of our markets right now. Okay, it's been down for a couple of days, and it's actually quite a surprise to me because I thought at the end of the Hungry Ghost month, there will be a sort of a rebound. I suspect the bearishness on the STI is probably due to our spiking COVID-19 numbers. All right. My personal view is that I'm actually quite bullish because I don't really care so much about the daily cases. There will be some hesitancy for the first few weeks, but once we reach about 2,000 cases a day, but we find that we can handle the number of hospitalization cases as well as ICU cases, I think we will become more confident enough to open up the rest of the economy. I remember that our government has a very difficult position, right? They have to balance between lives and livelihoods, right? And if 80% of the population is vaccinated, then I would say that I think you should balance out towards livelihood so that the F&B guys wouldn't starve to death, right? They run the business and they are dealing with a lot of interruptions. Okay, but that's my personal point of view. You don't really need to agree with me in that regard, right? Yeah. Okay. So to explain to the rest of the guys, why we're doing this. Okay. This isn't a typical kind of sales preview that I conduct. All right. The final slide for tonight's presentation, I'll show you where to sign up for the next preview. That's 27th of September. All right. The motivation is to showcase an advanced lecture for ERM graduates who have completed the program. So the material is not going to be easy for members of the public who come and listen. There will be one or two nuggets that I would do my best to explain to you as best as I can. But generally, I want to stretch myself as a trainer. I want to teach very difficult stuff so that at the end of the day, if you do not understand or you complain to Dr. Welf that I didn't do a good job, that's actually okay. Because I'm also trying to improve myself as a lecturer, right? This is the Feynman technique, right? Where Richard Feynman, a physicist, he says that the best way to master a subject is to teach it. All right, so you'll be seeing a lot of experimental stuff today. I guarantee that you will not find this in any other form of training, and it's free for members of the public. If you're willing to invest the time to listen to me, I will do my best. All right. Okay. For some other sessions, I might invite one or two guests to speak up on issues or finance and investing, but I'm basically showcasing some of the work of an Australian student of mine, brilliant guy, and I think his time zone is that he's hours ahead of us, so it might already be, I think, about 10:30 p.m. All right, so yeah, so I'll be narrating that component. I also don't want to trouble him, right, to do the presentation. Okay, it also allows alumni to keep in touch. Okay, there's also one way of alumni doing a Q&A with me, okay, with me answering verbally, because normally they will ask questions on the Facebook group and I will answer it, but I'll do my best to answer whatever questions you guys have. And of course, ultimately, well, I run a business, so I do want to demonstrate the long-term value of the early retirement masterclass. It is really one of its kind in Singapore, and we are more interested in teaching you guys the real stuff, right? How to gain financial independence. And I'm constantly improving my material, okay? And you will see that some of the material that I cover today, all right, will be actually taught maybe in a future program after I improve and I refine the slides. Okay, so let's jump in, all right? So let's really jump into our lecture for today. And let's go for the slideshow, okay, from the beginning. Okay, so welcome to our third quarter community gathering for ERM. Okay, So we do one session like this every 3 months where I tell Dr. Wealth that I'm not bringing in any business for them. It's basically just to keep the alumni notified on what we're doing, and for some of the fans to come in to ask some questions. So we've opened this up to public because we think that the public should also be exposed to have a certain idea of what kind of standard my students will be able to achieve after attending the 5-day program, right? And what we're going to do today is that today we're going to talk about applying international, our ERM framework to an international market. So if you actually have attended my preview before and you've not signed up as a student, or if you are a student, a lot of what we do is local, and that's because students are local and it's easier for them to be acclimatized to like all the local companies, the Temasek driven companies, right? So today we want to show how we actually apply this to an overseas market, right? And we'll be covering Australia first. Then after that, we will take the same framework, given that there is some sort of revision already for the people who are alumni. We will immediately take whatever we have and we will apply to the Chinese market. And then that requires that we answer a lot of fundamental questions about China that I will attempt to answer today. Hopefully, it wouldn't be the same kind of answer that you can get from another investment seminar, because I've deliberately not allowed myself to read what other Dr. Wealth trainers have said about China, and instead focusing on coming up with my own answer, right? It can be wrong, all right? And it's safe to disagree with me, but at least you have a different kind of perspective on the problem. Then we will run through the ERM portfolio update, how we have done as a portfolio. But today I'm not doing the best and worst portfolio, right? I did that 3 months ago. I'll only be covering the portfolio as a whole, which means that we have 22 portfolios to cover, right? And finally, this component is difficult to teach. I've decided to just throw it in just to try my luck to see the kind of response I can get from you guys. If you can last so long until this component, I'll be covering this thing known as a fractal markets hypothesis. All right, it's a fairly hot topic right now for quants, and I'll be sharing a little bit about what I know about it. If you have a quantitative analyst or investor, you might want to tune into what I have to say about this topic. All right, it's super interesting. Okay. All right, so just a word of warning, right? You might feel a little bit confused, all right, in today's material, right? It's mainly advanced material for ERM alumni, and the material condenses 5 days of workshop into a 15-minute summary. Okay. All right. Okay, now what I'm going to do is I'm going to just stop for just 10 seconds, all right? Because I think there's some noise in the background and I need to tone down the volume of my TV. All right, so just give me 1 minute. Okay, the first time it happened, all right? Yeah, I just got a new TV and it was very, very loud. Okay, international investing. Okay, so today what we're going to do is that just to demonstrate that our program, while we use Singapore data to conduct our training, the framework that we teach, actually it's very flexible and can be applied to markets like Australia, right? And normally on the last day of training, we do conduct a short little exercise, but it's a very short truncated exercise that we normally try to apply to either Bursa Malaysia or the Dow Jones Industrial Average. And what happened was in our latest batch, got a pretty brilliant student who applied the framework to Australia. So in batch 22, this student called Ludovic Chow, he actually didn't attend any of my live classes. He basically paid for the course and he went through the recording within his time zone. And then after that, he tried to apply it to the ASX, all right, which is the Australian Stock Exchange. Okay, and so what I'm going to do is that I'm going to elaborate on what he has done, and I'm going to explain to the alumni how you can make your first investment in Australia. All right. So for the folks who are members of the public and listening to me, it can be very intense. But I think if you are patient enough, you might be able to get 1 or 2 stock recommendations of your own that you can actually do deeper analysis. All right. Okay, so first of all, a little bit on the Australian Stock Exchange. For retail investors listening to me, you can invest in Australia via the code EWA. All right, so there is an ETF called EWA that allows you to invest in Australia. All right. For the folks that may have studied in Australia or Singaporeans contemplating emigration to Australia, you might want to play with this ETF to find out, well, what is the potential within that market. All right. And the ASX has blue chip stocks that are weighted by market capitalization. So we've got 50 of the largest Australian counters, okay, that form a very, very good kind of market for us to invest in. And if you are a Singapore investor, what you have to do is that if you have an interactive brokers account that I do cover in greater detail with my students, you need to seek permission to start trading in Australian stocks. So go to your account settings, scroll down to the stock trading permissions, then add Australia to the list of countries. It may take 24 to 48 hours for them to approve trading in Australia. Then after that, what would happen is that you can actually begin to start buying Australian counters in Singapore. All right. Here's an interesting note about interactive brokers. If you were to actually fund some of your purchases in Australian dollars, the margin financing rate is actually more competitive than the Singapore dollar. So for interactive brokers, we're paying 2.5% when we leverage, and it's actually 0.1 or 0.2 lower than a Singapore dollar loan. Okay, so it's something that you might want to think about. Okay, some useful facts about investing in Australia, right? Whatever dividends you get from Australia is taxable at 15%, okay? And it's already very much improved thanks to the Singapore-Australian double tax treaty. So if you're living in another country, you might be paying 30% taxes instead, okay? And the market is a lot deeper than our STI that consists of 30 stocks. So in terms of factor investing, right, it can be very easy. It can be very effective to actually cherry pick and select counters that are likely to outperform. Okay. All right. So to basically update the students on my program, on the last day of training, we conduct an emigration exercise, and we basically get students to fill out information on a country that they want to immigrate to. And then we would go through, get them to dig out some financial figures. Okay, so basically in the last round, the market seemed to be recovering from COVID-19. Okay, the equity risk premium is about slightly less than 3%, which means that Australian markets are a little bit pricey at the moment. Okay, if you're an expat living in Australia, you need to spend about 33,469 Singapore dollars a year. All right, so this is the amount of money that you'll be spending if you go to Australia as an expat on average. All right, and so you can do this to actually do a little bit of your retirement planning on the kind of lifestyle you're likely to sustain when you're there. And I've of course made my students dig out the expatriate expenses, because you can't live like a local when you're new to a country, right? So generally speaking, the kind of programs that I conduct, we have a yield in Singapore about 5 to 6%. So in order to be able to sustain yourself in Australia, you need a portfolio in Singapore about $600,000 in a leveraged blue chip portfolio that we build in the ERM program before you can sort of live freely in Australia. Okay, so generally speaking, Australia is an expensive country to emigrate to, and if you're looking for the kind of Australian laid-back kind of lifestyle, with about $600,000 in Singapore, you still need to do a little bit of work in Australia, which means that you might want to hold on to a middle income job in Perth when you actually settle down there. And that's not a bad thing, right? Because Australia really has one of the highest minimum wages in the world, all right? So yeah, so I think this is the kind of country that a lot of people in my class, they're very eager to pick Australia as an emigration destination. And then when they jump in to do the research, then they realize that actually it's quite an expensive country to retire on, but lifestyle-wise, work-wise, it's relaxed that way. Okay, yeah. So in my program, we cover about 5 or 6 destinations. All right. So I've basically just shared with everybody the numbers for Australia. Okay, so we're going to quickly go through in a very helicopter view how does the Australian stock exchange looks like. And this is the part that will be very confusing for members of the public. Like I said, if you find the material very interesting but confusing, the best solution is to sign up for my course. All right. Yeah. Otherwise, hopefully you'll still be able to get something out of it. All right. So we're going to break this down into 4 parts. We're going to talk about strategy selection, stock screening, how I selected my first stock, and how I did my market timing to get in. All right. Okay. So this is generally what my ERM students are all taught to do. And so what Ludovic did was he built a spreadsheet that contained a baseline strategy of investing in 50 Australian counters. And then he calculated their returns for 1 year, 3 years, 5 years, and 10 years. Okay. Then after that, he started cherry picking counters with the lowest PE. That means half of them, 24 out of 50 with the lowest PE, the lowest PB, and so on, right? And with that, he built a table, and then he started combining these factors together to find what they call a quintessential Australian strategy that worked. Okay. And this can be very, very confusing for members of the public. I'll just simplify it for you. So basically what Ludovic discovered through his R&D effort is that in Australia, looking for low price to earnings ratio has a tendency to work. Low price to book ratio works as well. High momentum or 180-day RSI, as well as high revenue growth, right? So when he was able to combine these factors together, right, basically he could use the computer software piinvesting.com, right, which I will cover in my program, and it would generate a list of stocks to buy, right? And it will even be ranked according to how high the scoring is, all right, based on the signal column. And you will find that in this particular table, the number one stock on the counter was Suncorp Group. So I was thinking to myself, you know, Ludovic put in so much effort to do this. It doesn't make sense for me not to buy something. So what I did was I cherry picked Suncorp Group, right? Cherry picked Suncorp Group, which is the top scoring company, and it does look quite good, right? Price to book ratio a little bit high, but the P ratio is quite low, right? So it's cheap. Revenue growth is a little bit negative for now, maybe because of COVID. Okay, but it's got fair amount of interest or momentum over the short term. Okay, and it's a top scorer. So so that's what we're going to do. We're going to take Suncorp Group, and I'm going to see whether it's actually worth buying. Okay, so I started doing some qualitative research on Suncorp Group, and I realized that this is actually insurance company. It provides some banking, insurance, and wealth management solutions. Very decent dividend yield of 6.37%. So the moment I see high dividends, I start to salivate, and even after the withholding taxes, I cut off 15%. I'm still getting maybe about 5%. So that's not a very bad portfolio for us. And I could put in a really small position into Suncorp Group just for fun, right? Just for fun. So that's exactly what I did. Okay, I went ahead. I did a little bit of technical analysis. All right, and this is what they call the breakout method of investing, right? Where I look for a parameter that gives me the best breakup buy parameter and the best breakup sell parameter. And then what the system will do, what Pi Investing will do, is that it will tell me that there's a green arrow here, which means that Suncorp is actually on its way up, right? Which means that from a technical perspective, it's actually worth buying. Okay, so basically with all the fundamentals in place and the technical signals in place, there's nothing left to do other than to actually buy it. So I took a very, very small position. I bought 100 shares about a week ago when I'm producing these slides. And for my interactive brokers, I'm currently leveraged at about 2.2, okay? But it's a very small position. It's just about $1,200, right? It's not, it's meaningful, but at least, you know, my students have done such a good job. It didn't make sense that I didn't put in a little bit of money, okay? Right, so the result is, if you look at Suncorp now, I'm down slightly, okay? But, you know, there's always some volatility when you buy and sell. But I hope that as I hold on to it, it will pay me about 6%, 5 to 6% every year. And actually, I don't intend to go back to look at it to see how it's doing, okay? Yeah, and that's it, right? So within this short period of time, I've demonstrated how my framework for investing can be applied to the overseas market. And you just need to devote about 1 or 2 hours, right? So Ludovic spent, I think, about 1 or 2 hours after attending a 5-day program with me, okay? And for the alumni, if you're from an earlier batch, right, and the material seems confusing and new to you, okay, we have a link to a refresher course, right? We try to break even for this course. So it's at $420, right? Just click onto it. If you have any questions, just look for me on the Facebook group, all right? Yeah. Okay, so yeah, so imagine, right, if you have attended the program, then it's very easy to understand how to actually take a particular framework and move it overseas. But the truth is that I think Australia is actually quite an easy place to invest in. If you look at the factors, very friendly to value investors, growth investors, commodity kind of currency, country, full of natural resources, right? Which means it hasn't got a recession for, I think, 25 years prior to the pandemic. Okay, so I think it's actually a very good place to park a little bit of your money, all right? Even though I'm not playing a lot, right? if I build an Australian fund, I know exactly how I'm going to do it. All right. My students actually know how to build an Australian fund. All right. So now what I'm going to do is I'm going to take the same framework and you've had your warm up and I'm going to apply it to China, which is actually a very difficult market to invest in. Okay. And whatever tool that we have that is quantitative, somehow I feel that it is very difficult to actually have a strong grasp of Chinese politics. All right. So what I'm going to do today, and I just want to demonstrate that most people, the so-called gurus, trainers, when it comes to China, the truth is that we really don't know what the hell is happening. All right. And the best we can do is we apply some first principles into the country, and then we hope for the best. All right. We hope for the best. Okay. Now, a lot of negativity in China, and in fact, right now, it's still going on, right? And you're seeing that the Macau casinos have taken a hit today. Okay, which means that they've got basically a relentless kind of government. All right, it's trying to spread prosperity in a common way. All right. Okay, so where do I get my material from? I get my material from Ruchir Summers' 10 Rules of Successful Nations. I read his book called The Rise and Fall of Nations. I was extremely impressed with it. And I think that this is how you should be analyzing a particular country, right? You find someone who is a bit better expert than you. If he can successfully distill it down to a set of rules of thumb, right? You take it and then you try to apply it to a particular country. So what I've done is I've applied these 10 rules to China, and 7 rules turn out to be rather positive. And what I've done is I've created a negative case for investing in China. All right. And these are the 3 things that you need to think about before you actually move your money into China. Okay. And unless you can really think clearly about this, okay, the answer is generally you shouldn't invest in a country that you don't understand. All right. And I've divided it into 3 parts. So my first discussion will be on demographics, and the second will be on political reforms, and the third concern will be on private sector debt levels. All right, so let's go through each of them one by one. Okay, so the first issue that I think that everybody should think about in China is not so much of what the government is doing, but the fact that China is not growing anymore, right? The TFR, the total fertility rate of the Chinese population, it's now less than 1.5. So like Singapore, we've gone through that process. We have the stop at 2 policy and then have 3 or more, right, after that. So China is going through that same problem right now, right? And in a urbanized kind of population, that's knowledge driven. It is very difficult to convince women to have children because women are better off building their own careers and they're happy that way, right? So that's happening in China right now. And according to the author of the book, a working population, right, that is not growing makes it very difficult to create the condition for an economic boom. All right. So if the working population cannot be maintained at a growth rate of 2%, then an economic boom is impossible in his view. So with that, I think this is probably the most negative thing about China. Okay. But the author admits that there are 4 ways to avoid that. All right. So the first is to get more women into the workforce. The second is to basically allow more immigrants, okay? Or the third method is to actually employ robotics, right? So if you're reading anything on China, you got to understand that the situation for the population is not so good. They might grow older before they become richer. And without a strong, vibrant kind of economy driven by their population, right, you'll be looking at 3 things. You want to see more Chinese women enter the workforce. You want to see China accepting immigrants, which is very hard, right? China will probably offer ethnic Chinese like Singaporeans and Malaysians some kind of easy way to settle down and get a work permit there, right? You want to see news like this show up, and you want to see a lot more robotics and automation in China, all right? So these are the 3 things that would have to happen at the same time for you to make this negative a positive, right? Okay, the second point is political reforms, okay? And we have to accept that China's era for reforms, which is during the Deng Xiaoping era, right, is over. Okay, so Deng Xiaoping basically came to Singapore. He tried to learn from Lee Kuan Yew, and his era is over. Okay, and what the author said about having a reformer leading a country is that there's always some preference for fresh leadership. Okay, and the problem is that President Xi has basically extended his term limits, and he doesn't have a successor in mind. And because of that, right, I could say with a certain probability that China no longer have a reformist that's actually leading the country, right? And so when you're not seeing charismatic leadership with a popular base support, okay, you're actually seeing a very autocratic kind of leadership coming into China, right? And so you're seeing some sort of a war that's happening against the entrepreneurs, okay? And one of the things that concern me about the idea of common prosperity is that when you want to cut the pie into equal slices, right, it almost results in an overall smaller pie for everyone, right? That's the kind of trade-off that China wants to do, right? I don't see any reason how the pie is going to get bigger with this kind of reforms coming in. You're going to have a more equal kind of society, but you're not going to have the kind of society where it's worth inventing something and becoming a millionaire anymore, right? So I think that is the problem, okay? Now, the only exception to the rule where a country has been reforming itself longer than 4 to 5 years is Singapore. And Singapore has always been an exception to the rule in many of these books on politics and the economy. And Lee Kuan Yew was a reformer for over 30 years. All right. So if you want to invest in China, you have to convince yourself that President Xi is a Lee Kuan Yew-like kind of character. And common prosperity is an extension of the Deng Xiaoping reforms stretched over multiple years. If you can convince yourself of that, then maybe there might be a case to invest in China. All right. Okay, the third one is the problem of private debt levels. And the general rule of thumb in the book is that as private debt levels go up for the last 5 years, odds of a very drastic drop in GDP growth is extremely high. So what I've done here is that from an independent source, trading economics, right, which I cover with my students, we find that the debt to GDP growth in China has been going up, all right? So they've been borrowing more money, but we really don't know where that money is going to. Now, typically in China, right, if you understand how they think, I expect the money to go into real estate, which is you're not really trying to build a factory, you're not really trying to innovate, right? You're likely to move your money into the stock market by leveraging it, or you're putting your money into real estate, right? Getting bigger and better houses. Yeah. So I think that is the problem, right? If you're getting debt to run tech companies, it might actually be good for a particular country, okay? But this is actually a very bad sign, all right? And that you're likely to see continued decline in GDP growth in China in the future, all right? Yeah, the author admits that he got a lot of critics about China got their analysis wrong because they didn't expect the tech sector to do so well for the past 10 years. Okay, otherwise, this private debt problem, shadow banking, has been a problem in China for a very long time. So this is the third area that you might want to look at. So when you read a newspaper article on China, right, you might want to think about things like your debt levels, right? Okay, so there are 3 ways to think about China, okay? And the first question is China addressing the shrinking workforce? What are they doing? Are they adding automation or women into their factories, all right? It's something that you need to think about. Does common prosperity receive very popular base support from the ground? I can't tell because there's a lot of propaganda going on. I'm sure a highly trained Chinese analyst might say, yes, there is popular support from the ground because there is a lot of inequality right now, but I'm not too sure, all right? So we will continue to read Chinese news, and then we will also have to read the biased Western media as well to get a deeper grasp on this issue. And finally, what is China doing about their shadow banking problem, right? It's really not good if the people basically borrow a lot of money to play the stock market or buy homes, right? And I think one way of looking at it is this. Now, you know, China has been killing off their girl babies for many years, right? When they had the one-child policy. So what has happened over the years is that they built this gender imbalance between men and women. And they're basically, I think, about 120 men for 100 women in the Chinese population. And so men need to get married, right? And to get married, right, the women demand that they own a house. And so there is this struggle for a bachelor, right, to buy a house to impress a mate. And to do that, you need to take on a lot of leverage, right? You need to borrow a lot of money to do that. Yeah. And so in other like Latin American countries, and normally if you leverage a lot of money into real estate and there's a collapse in real estate prices, basically the entire economy just breaks down, right? You end up in a crash situation. So this is the third thing that I want to leave with you guys. Okay. Okay, so this is my best answer to China. Okay, yeah, I've deliberately refused to read the latest book. So after I make this presentation, I'm going to read about Red Roulette and some of the more popular books about Chinese culture and politics. All right, but I think that the Rise and Fall of Nations is a very neutral piece of work, right? Because it teaches you how to analyze a particular situation. Okay, so with the macro economy done, right? Let's dive into what we're doing about China for ERM. Okay. Okay. So actually it's not really investing in China, right? So what happened was talking to another Dr. Wealth trainer, this guy called Yao Nan, right? He's a specialist in China. And he's been telling me of his frustration because as a Dr. Wealth trainer, people have been calling him to sort of mock him, right? Because the Chinese markets are not doing very well. And I've had my own experience of being mocked last year on March 2020. So when I started to leverage and the Singapore markets went up, right, our portfolio began to do very well. Okay, but I will never forget the time when there was a serious crash in the real estate investment trust. And I basically got hammered by the people who read my blog. Some fake friends who know that I'm a trainer would come and make fun of me, right? So now the situation is that the Dr. Wealth trainer Yao Nan is going through the same process, right? So I told him that, you know, my experience is that if a Dr. Wealth trainer gets mocked, right, it means that he's going to make a lot of money if he puts his money into a market, because it means that the market is very cheap. Okay, so Yao Nan said, okay, why not, right, incorporate the Hang Seng China Enterprises Index into ERM, to which I said I'm very open-minded to do so. All right, and here's some of the information. So the Hang Seng China Enterprises Index is also market capitalization, has 50 stocks. All right, has 50 stocks. Okay, that can be used to do a little bit of back testing. All right, and Hong Kong's withholding tax is 0%. Okay, trading is allowed on interactive brokers. You don't have to enable any permissions, but the problem is, if you borrow denominated in Hong Kong dollars, your margin financing interest rate is 3.5%, right? So I can't really make my Hong Kong stocks a large component of my interactive brokers kind of investment. Okay, but nevertheless, I'm only making one investment, right, from today's exercise. It's not so bad. Okay. All right, so my students are taught how to calculate the equity risk premium. So if you look at a PE ratio of the Hang Seng China Enterprise Index, 12.56. So we invert it, you get 7.96. The 20-year Chinese bond is 3.41. So the premium right now is 4.55%. This is a very good number. All right, so normally when you see anything above 4% for the equity risk premium, generally speaking, the markets are cheap. Okay, but it also means that there is strife in the markets, right? So the Chinese government is rapidly interfering with the financial markets. So it doesn't mean that you can make money, right? You can still lose money even though the Chinese government, the Chinese stocks are actually very cheap. Okay, and compare that with Singapore, our equity risk premium is 3.26. I would say that right now, these 50 stocks in the Hang Seng is cheaper than Singapore, right? So cheaper means cannot buy too much, but maybe you buy a little bit and then you observe what happens. All right. Okay, so this is exactly what I did, right? So I took the ERM thing and I built the same table that I teach all my students. All right, and we basically shortlisted 4 factors. All right, low 6-month volume, high free cash flow yield. All right, so companies that generate a lot of cash flow from operations from their business tend to do very well. High return on invested capital, and finally a very low payout ratio. So when you combine all this together, right, actually the 10-year return is not too bad using these 4 factors, 29.2%, and we've got basically volatility of 16.8%. All right, so very, very good, very sexy kind of returns. The maximum drawdown, unfortunately, is high, 56.4%. So it barely supports the idea of leverage. All right, so you want to leverage, please combine it with some Singapore and Australian stocks, and you keep it around 1.5. All right, if you're playing, if you're a student and you know what I'm talking about, right? We keep leverage low so that it doesn't destroy you. Okay. Yeah, and so we carry on and we take the factors and we build our stock screen and we find the same table with signals And once again, we find a very, very interesting counter that's almost exactly like the Australian counter that we have. So 2601, China Pacific Insurance. All right, China Pacific Insurance, that's the #1 stock on the list. Okay, so this is exactly what I'm going to do. I'm going to see whether China Pacific is worth buying. The code is 2601. All right, so I go through the same process. This is an insurance company. Then I found a DBS Treasures report. It's got a positive report with a target price of $38, and it is very fresh. It is a August 2021 report. Dividend yield 6.9%. All right, basically I see that out, right? I want my money to make more money for me, so I really get happy, right, when I see a yield like this. So without any delay, I went in, I checked to see what the heat map is. And once again, the technical indicators show that it has rapidly turned around quite recently. So go ahead and buy. All right, so I went ahead and I bought, okay. I bought at 23.70, down slightly. All right, everything I buy is down slightly because of the move from the Chinese party, but I don't really care anymore. Once I buy it, I just leave it there and I let it churn out dividends for me over the long term. All right, yeah. So basically that's it, right? I could explain China in such a short time, okay? And this is just demonstrate to the critics that my ERM program, even though when you come from my program, it teaches the Singapore markets, the truth is that it is a framework that can be applied to any new market. And we will know that if a market is not friendly to value investors or growth investors, right? Like earlier in this case, we see that Australia price to book ratio, price to earnings ratio worked very well. In the case of China, it can lead to underperformance. Right, so my students can tell the difference, all right, after they learn how to actually produce these tables. All right, and I've shown you basically how I could take first position in China Pacific Insurance. All right, whether you do well or not, we don't know. Okay, but I think you'll probably do better than the index. All right, okay. Okay, so we're done with the main parts of our program. What I'm going to do next is that we're just going to have a very short update for the alumni and for members of the public to see how we have performed so far. So I've graduated 22 batches of students so far. And to understand my portfolio, right, and the portfolio that my students are taught to build, the final outcome is that we tend to build very stable portfolios with a volatility that is 20% below the rest of the market, right? The reason is because I tend to attract students who are more conservative. They like investing in dividends. And so we build these portfolios that let them sleep very well at night, okay? And the next thing I want you guys to take note of is that typically, right, when we invest, we get about 5% dividend yield. So this is roughly the kind of portfolio that my students build for themselves, all right? Yeah. Okay, and normally what we do is that I don't make the central decision when buying stocks. My students are taught finance and then they make the decision. And then I will invest my trading fees into the portfolios that they build. Now, how is that possible? It's only possible if the trainer is himself financially independent. And I can redirect all my earnings from my investment courses into these portfolios built by my students. And that's very important, right? It means I have skin in the game. And that if my students make an investment mistake, I'll be the first to suffer for it. All right. Okay, so let's jump into our current return so far. It's not particularly stellar, 7.98%. All right, overall since the beginning of the course. Now remember that we had to go through periods of time where students get stuck just before the crash, the pandemic of 2020, and I basically included all their results into one page. So there isn't any specific attempt to select only the best counters that I have from my student portfolio. This is everything. This is all in our performance. Okay. Of course, it is down slightly due to the Hungry Ghost month, but the truth is that the Hungry Ghost month extended itself way into September. So we're not getting a lot of good news yet. Now, I am cautiously optimistic that on 20th of September, things are going to get better because a lot of REITs are going to get into the NAREIT EPRA index. All right, so I'm cautiously optimistic. And the other good news is that Temasek $1 billion fund that's going to be farmed into our mid-cap stocks, and we're seeing some improvements in our performance straight away once that news has already come out. So I'm cautiously optimistic on the future. All right. Okay, if you compare our performance with our benchmark, which is the STI index, we've done very well. All right, we've outperformed 3 years in a row, 2019, 2020. And guess what? In 2021, we were behind, right? In my last update, we were not doing as well as the rest of the STI. We have actually caught up. We've actually caught up, right? And our overall return, 23.94%, is actually better than the overall 6.95 for the STI ETF. So this is not a joke, right? My students, and it's not built by me, they're built by my students. So my students really do know how to build portfolios that work better than what the average has done, right? So I really think that my students really know a little bit about investing after attending my program. Okay, all right. Okay, for the people that want to see the actual stocks and all that, I'm happy to share that we have really bad investments in our portfolio. So Eagle Hospitality Trust burnt us, right, for 100% losses. All right, so we do make investment mistakes, right? We are human beings after all, and I don't want people to think that just because you're a trainer, your portfolio must be perfect. And I also don't like other trainers that like to show only their best results. I love showing you the really crappy mistakes I made. All right, so first read as well, it sounded so good, then after that it went to hell. Yeah, Comfort Delgro, actually I didn't expect it to do so badly, you know, to be actually one of the worst 5 holdings that I have, right? And Fraser's Hospitality Trust, I don't really blame them, right? I blame the pandemic for the underperformance. But of course, we've also got big winners, right? Propnex is our top winner. We've got Hourglass, and of course we've got Franken, right? So Franken is likely to do even better. Okay, and you also see like Parkway Life REIT lah and Yang Zixiang in our portfolio. Yang Zixiang, we timed our markets really well. We basically got on board before all the good news started to come in. All right, yeah. So this is a real portfolio. There's real money in it. Okay, and it's in fact leveraged. So whatever returns produced by the portfolio, I get about double that amount of returns. All right, so yeah, so there's real money playing here. Okay. All right, so this is just a demonstration that the students learn how to apply the framework. They make joint decisions as a class. The instructor invests in a portfolio, right? And our performance is objectively 3 times better than the STI ETF. All right, so imagine what kind of performance the framework would have if we apply it on a market that has done well, right? So if we have applied this framework to the Dow Jones Industrial Average, but I prefer to deal with blue chips of different countries, right? You would be able to get the results that would probably be better than what the index has done, right? Because I know that a lot of people ask me, so Chris, what about the US markets, right? Can I apply this to the US markets? I said you can, okay, but I'm keeping it a secret for my students because the truth is that next year I might be developing the US version of ERM, all right? Same framework, but US stocks, all right? Yeah. Okay, because that's very popular, and we're trying to become more international, right, in our online programs. Okay, all right. So not too bad. 84 people have survived along with me until this is the last section before before I have 5 slides to just tell you all the promotions that we have for alumni, promotions that we have. Okay, all right. So what am I working on? The next question is, so the answer is I'm working on this thing called Fractal's market hypothesis. All right, and before I even managed to master this, I've decided to create about 5 or 6 slides to attempt to explain to you what I'm doing and why it's very fun, and why maybe 1 year into the future it might actually crop up in the actual training for ERM. And for members of the public, if you are a quantitative investor, your hedge fund manager, you might want to pay attention to this. All right, this is fairly sexy stuff. All right, and if it's not sexy enough and all that, then you just complain to Dr. Welf. All right, okay. So what is the fractal market hypothesis, right? In order to understand it, we have to understand what the efficient market hypothesis is. All right, it's initially this idea that is very old that says that technical analysis is impossible because all the information is embedded in the price and the volume of a time series, which is the stock market price. All right, so you can't make a lot of money by reading tea leaves and applying technical indicators to stock investing. Okay, and this efficient markets hypothesis dominated the finance world for many decades, but they couldn't explain why people do make money. Why are traders still rich, and they're richer than academics, right? Yeah, so recently somebody has come up with an elaboration, and in fact, I think this is a vastly superior theory. So the fractal markets hypothesis basically says this, all right, how the market works is that normally investors with different horizons participate in the market at the same time. Now that makes sense. right? There are some people who can hold a stock for 5 minutes to 3 hours. There are computer algorithms that buy and sell within nanoseconds, right, of performing a trade. But at the same time, there are people like the Temasek companies that have a time horizon of 100 years because they manage a nation's money. And then there are people like you and me who have a horizon of about 20 years, right? And so when we are all participating in the markets at the same time and we have a different market horizon, the markets are behaving normally, right? Normally means that you have a return, you got a standard deviation, and it follows a bell curve, right? It follows a bell curve. Now, something happens every now and then, every 2 to 3 years, every 7 to 8 years, you have a situation where there's turbulence and there are crashes. And typically what happens when there's a crash, basically a large population of investors suddenly decide to have the same time horizon, which is like 2 days, right? I better sell today because otherwise tomorrow I'll be dead meat, right? If the market continues to crash. So that's what happened in March 2020, right? And so modeling financial markets, right, with a normal distribution doesn't work because of these occasions where sometimes everybody's time horizon becomes the same, right? And that's basically what this fractal market hypothesis is in a nutshell, okay? Now, so what I teach in my program is that we try to model markets as a normal distribution curve, right? And if you were to arrange all your daily returns together in the form of a histogram, you end up with a curve that looks very beautiful like this, right? But the truth is that it doesn't really happen in practice. So there are some civil engineers who are working on the Nile River, and they're calculating the frequency of floods at the Nile. And they find that when you have a flood, right, and you measure the extent of the flood, you realize that some time series have this concept of memory. That means how badly we flood this time round depends on how badly we flood the last time round. So if the flood was very bad the last time round, this time round we're going to get a pretty bad flood as well, right? Yeah, and that happens until the situation reverses itself once, and then things might get better, all right? So that's the crux of Fractal's market hypothesis. We want to measure how much memory is embedded in stock prices, all right? And the method to do that is this mathematical construct called a Hurst exponent, right? The Hurst exponent, for the people listening to me, you just need to understand that it is a number, okay? It is a number between 0 and 1. If it is 0.5, then there is no memory in the curve, right? It is a normal distribution curve when you look at returns and standard deviation. If the number is above 0.5, then there is some memory, and technical analysis can possibly work in this market. That means higher values lead to even higher values, and the long-term value is generally quite high if it's gone up in the past. So where H is more than 0.5, technical analysis, looking at the stock moon, works, all right? Now, if H is less than 0.5, then there is reversion, all right? Higher values will be followed by lower values, and numbers have a tendency to stabilize over time, right? So the question mark that I want to ask myself over the past few days is, what is the Hurst exponent for markets that ERM has a tendency to be involved in, all right? So which is a local stock market. And this is something you can't find in any of the research papers because very few people would bother to calculate the Hurst exponent of the STI, right? So fortunately for me, I found Python code that has already been done by someone else. So I imported their library into my, my Jupyter notebook. And I found myself able to actually generate the Hurst exponent very easily. And I did this within 30 minutes of some Googling, right? Because I already have the infrastructure in place, right? It's a little bit cheap, right? You got to gather all the data, put everything in the data frame, then it will attempt to like draw a line across points and all that, right? So that I can't explain in such a short time, okay? Yeah, but I think for the people who are listening to me, you might like what I have on this table. So if you look at our local stock market, right, the Hurst exponent is about 0.53, which is not too bad, a little bit of memory. So you can do a little bit of trading on STI. And generally, if it goes up a bit, it will go up in the future, all right? There is a trending element because of dividends, right? And if you were to do the same thing on real estate investment trust, you realize that real estate investment trust is closer to the ideal normal distribution curve, right, of 0.51. All right. Okay, Go has a lot of memory embedded in it, and it's normally a good place for technical analysis to play with. Now, the most important result, right, is government bonds. So government bonds is the opposite of everything that we've done so far. We see that the Hurst exponent, right, is below 0.5. So if you combine government bonds with STI ETF, you can basically do asset allocation, right, and maintain your allocation at about 50%. It will slowly make some money for you because when the government bond drops, you buy more, and when the government bond fund recovers, you buy less, right, or you sell more, right? So this kind of rebalancing, right, works very well for anything that's less than 0.5. Right, for anything more than 0.5, you can do something like momentum play and your moving average intersections. Okay, and here's the sexy thing, right? The reason why Bitcoins have made people a lot of money is because of this ridiculously high Hurst exponent, right? Which means that when the Bitcoin drops, right, it drops a lot, and the drop depends on yesterday's drop. But when the Bitcoin begins to moon, right, from the bottom, right, it goes up very high for the next few weeks, right? So that's what happens in practice. So you can actually use these trading methods, trading breakout methodology on Bitcoin, and you make a lot of money. And many people have made a lot of money doing that. Okay, so that's something that you have learned from my slide. Okay. Yeah, and basically that's just it, right? Right now, I am trying to develop the Hurst exponent for blended portfolios, right? So I'm obviously going to do that for my ERM portfolio, and then I'm going to apply that to see whether there's a combination of ETFs that we can use to do rebalancing, right? Yeah, so I have a course on building an equity portfolio, but the truth is that I really do want to teach a cheaper program for people to build ETF portfolios. But it'll be much cheaper than my current program that I run. Yeah, and so I still want to bring a lot of data science into the picture, but right now I don't have a course in me yet, right? Because we want something that is new and is novel and would basically blow the competition right out of the water. Okay. All right. So well, that's basically it for my presentation for the community event. What I'm going to do now is that there'll only be 3 to 4 slides to talk about what goodies I've prepared for the alumni. All right. So for the alumni, why take the ERM refresher? So it is now a 4-day webinar with 1 day worth of lab. And basically at the end of it, you'll be able to understand exactly what I've covered for today. All right. We are no longer dependent on Bloomberg, and we have a crowdsourcing tool. I've written a web page, hosted it on the cloud with my own engineering capabilities that my students now use to crowdsource information. So when you trade with me, you are my analyst. I'm like your boss telling you what to do, how to select your stocks. And as a company together, company about 15 to 16 people, we build a portfolio together. All right, so that's how it works. Now I have the software to do it because I wrote it from ground up. All right, now the best people to take the refresher is batch 11 and below. All right, don't attend my class last week and then go for the refresher. Right? Yeah, no point. Okay, the material is still fresh in your mind. All right, so if you are older alumni, you might want to do that. All right, $428. You can sign up on the link here. Okay, 9 to the 12th of November 2021. That's the time for the next course. All right, on the 13th of November, we meet face to face and we will have a lab session. Okay, this other promotion for the folks that are part of my program, but you're too busy to actually build your portfolio. I am part of IFA's Global Markets Advice Portfolio group, where I introduce my students to this guy called Yang Zhi, who's a financial advisor. And what he will do is that he will construct a portfolio for you that will mirror the ERM experience. Okay, because you're too busy to do it, right? So we have a way of doing it through a fund. All right, the minimum amount for the student is $25,000. You can build a portfolio that will automatically deal with all the rights issues, reinvest your dividends, and do everything for you so that it's totally hands-off. So you might want to take a photo of this page and then use a QR code to look for Yang Zhi if you're interested in this program. All right, I won't spend a lot of time talking about it. All right, but if you're one of those that like the course, like the results, but don't have the time, this is something I have for you. There is a management fee, of course, right? Okay, for alumni who introduce new students to my program, I'm sorry it took me 22 batches to figure this out, all right? But what we've done is with Dr. Wealth is that when you introduce a new student to my program now, we'll give you $100, all right? Yeah, so that if you're part of the program, there's a way for you to make some income. It's not passive though, it's active income, but it's like a side gig lah. All right. So if you can find people who can come along with me and all that, just inform Dr. Wealth. Have the student inform Dr. Wealth who was the introducer, and we'll make sure that you're able to get $100 from it. So I think this is the biggest news for the alumni, right? Yeah. So if you come for my community event, I will find a way to share some lobangs with you. Okay, and finally, for members of the public who want more information on my early retirement masterclass, this is not my ordinary sales session. My ordinary sales session is about 2 hours long with very little sales, and it's informative. And the next preview is on the 27th of September. So you might want to sign up on this link, right? So that you can come for my presentation on the 27th September. All new material compared to what we have here. And hopefully, I treat that as a performance. It's like a musical, you know. Yeah, and hopefully you can use it to add some value in your life. So even if you are not intending to sign up for an investment course, you might want to attend my preview anyway to be entertained or to learn something in the process, right? So I strongly encourage you guys to do that. Okay. All right, and well, that is the end of our program for today. Okay, and yeah, and I'm going to just scroll down the chat, and for the people who are asking questions and all that, I will do my best to answer all the questions that you have. All right, you've invested a lot of time with me. Your alumni, go ahead and ask questions, and I will answer them to the best of my ability. All right, so Rico, all right, okay, okay. Edmund Wu, how about Tiger and Mumu? Okay, so for the brokers like Tiger, okay, Luther is an alumni and he's helped me answer the question. So actually, Tiger will grant you access to Australia. In fact, I didn't know that. Now, I'm not a customer for Tiger and Mumu, so I can't really comment on it, all right? But I understand that if you sign up with these very aggressive Chinese brokers, they might give you a free Apple share, all right? And that's trending in the markets right now, all right? But I don't go with that. With my students, I teach them how to use interactive brokers, right? Interactive brokers, okay? Yeah, correct. EWA, Eric Neo, is a exchange traded fund that is in the US stock exchange. So when you buy EWA on the US stock exchange, in essence, you are investing in the Australian stock market. All of it, okay? Can we convert the HKD leverage to SGD, Sun Hui, to enjoy the 2.5% margin rate? The Singapore margin rate is actually higher than 2.5 right now. It's 2.7. So if you convert HKD to SGD, then you'll be paying 2.7. And yes, you can. All right, Gabriel, my old friend, Gabriel always comes to my community event. All right, yeah, he got burned by first read. Yeah, so did I. All right. If there are any investment trainer who tells you that they didn't get burned by a stock, you're probably charlatans. All right. I lose money all the time. All right, and I make horrible mistakes. Okay. So the important thing is that you make good moves that can offset your mistakes. All right. I think that's how investment should be like. All right, so Justin Lam, how much is the ERM refresher? $428. All right, you can come for the next program. Yeah, so yeah, you can. I think you are an old customer, right? So I think it's okay. yeah, I just don't want the newer customers to come for the refresher because it's actually a waste of their money, right? Kelvin Koch, can you post the refresher link again? I will do that on the chat group. Let me I tell you what, Kelvin Koch, go to the Facebook group. Okay, the Facebook group has a refresher link as well, right? And you can sign up for it if you wish. Okay. You mentioned plans for ERM for USD. Any plans for ERM for ASX? No. This presentation is the only plan that I have for ERM for the ASX. All right. We are experimenting with Dr. Wealth for getting overseas customers, right? So right now we don't have plans for Australia yet. All right. But I think if you are living in Australia, what I'll do is I'll hook you up with all the Australian investors in the network, and then you guys can create your own models there. All right. So so I think that's the best. Now the plans for a US dollar version for ERM, likely 2022. All right, likely 2022. All right. I need to convince myself that there's money to be made here. Okay. Casey Chong, alumni here. IBKR has raised their rates twice since May. Now it's 2.7 now. Is there any better broker? No. All right. The next cheapest broker, Maybank Kim Eng, is 2.8. All right, it's 2.8. So interactive brokers remain the cheapest way to get leverage in Singapore. So I hope that I've been trying to talk to Tiger and Mumu to actually go in and to actually give us a good rate, right? Yeah, but they're not interested. Okay. Other than going for the refresher, is there a repository of information on slides or Facebook group to look through first for the backtesting strategy? Okay, so Brandon, that's the feature of the Facebook group, right? I can show, we do provide the final portfolio, but the lecture slides, we don't provide it, right? So yeah, so the refresher is the only way to get hold of it, right? Unfortunately, yeah, we run a business, right? Yeah, so that's the only way. What you can do is that you can read the Dr. Well blog where I talk about some of the ways which I invest. You might be able to get an update there. So Justin, you're from batch 13. Batch 13 should be fine to come for a refresher. All right, not too early. Batch 13 is okay. Brandon Hong, any thoughts on Genting Singapore? I think batch 5 or 6 bought in anticipation. Now they've announced there's no more. Should we offload? Yeah, Brandon, I think you should offload Genting. All right. I don't see a lot of future given that there's a China crackdown. And I don't see casinos coming back, right? Yeah. So what you do is that you can either offload or you wait to see whether our ICU numbers for the vaccine has stabilized, right? So that would decide whether you want to offload. All right. I'm for offloading it personally. Okay. Yeah, Ronald has an FB post up. Yeah, you remember the Ronald post, Luther. Oh, that's good. Yeah, you can also go there and find out whether there's any summary. Okay, so Chong Casey, if alumni wants to follow future batches of portfolios, how should we cherry pick which stocks to buy if we have limited funds, right? Okay, so normally if you do not know how to pick the one that gives you the highest dividends, right? So that's what we do. Now, actually, we do cover that in detail in the refreshers. We pick those with the highest signal score. All right, the highest signal score will determine how to go. All right. Any other programs? What are you coming up? Unfortunately, no. I'm fairly busy. I'm thinking of running a pretty. I'm thinking of running an introduction to Python programming course. That one won't make me a lot of money, but if I do launch it, I'll let you know. Peter McCockendale, I'm batch 4. The 4-day course is online or classroom. So 4 days online, 1 day face-to-face. All right, 4 day online, 1 day face-to-face. And on the face-to-face day, it's recorded. So you don't actually need to be present. All right. Desmond Tan, is it a must to use IBKR? I'm from an old batch. I'm happy with MBK. I tell you, MBKE gives fantastic service. All right, IBKR is cheaper, but the service is so-so. All right, so it is not a must to use IBKR. All right, although now my training program, I do spend a lot of time explaining how to read the IBKR dashboard. Right, so we've slowly moved into IBKR because it's been cheap for a very long time. What is your view for silver or gold, please? I do not have a view for silver or gold. I'm very, very sorry. This is the domain of technical analysts. All right, so I really cannot talk about silver. Yeah, that's not that. Okay, so you're looking forward to the Python introductory course. Yeah, but the thing is that my Python needs to be good first, right? So I really need to upgrade that. Okay, Chong, Casey, didn't see the Z score in your latest 22 batch. Yeah, that's why it's hard to cherry pick. Yeah, that's right. We don't publish the Z score in our final portfolio stands. All right. I see what I can do. All right, for batch 23. Okay, I see what I can do. No promises. Okay. So thanks, Chris. Will this be available on Facebook? There's a recording for this particular session. It will probably be shared on Facebook. Okay, Justin Lam, what about Poems? Poems is great. All right, Poems has very good service. Okay, Poems is a little bit expensive for the margin financing, but the difference is now quite small. All right, Irene Chong, I'm from batch 21. Have you conducted the lab session face-to-face? I haven't been informed of it. Oh no. Irene, can you talk to the Dr. L staff? Because I have been conducting the lab session face-to-face for a while already. Okay. Batch 21, you should have met me face-to-face actually, right? So no worries, I will find a way. Yeah, no worries. I will find a way to ensure that if you haven't attended a face-to-face session with me, you will get one no matter what. All right, you get one no matter what. Okay, so I don't know how you missed that. Okay. All right. Okay. I guess yeah, there is live streaming, okay, and yeah, there was, yeah, okay, so you guys are talking among yourselves. Okay, all right, so okay, so you read what Dr. Wealth is saying, right? If you want the recording, send an email to admin and Dr. Wealth, and we'll send you the link to that. Okay, all right. Do you think that China valuations versus risk is attractive enough currently? Actually, I tried to subtly answer the question. The answer is that the valuation is quite cheap, right? You saw the 4% equity risk premium. So from a numbers perspective, it is cheap. But from a qualitative perspective, nobody knows what the Chinese Communist government is trying to do, right? And that is why I only bought, actually I have 3 stocks, right? I have ICBC, I have Post Office Bank of China, and I've got China Pacific, right? Which I shared with you. I'm not buying anymore, right? I'm not buying anymore because I don't know what presidency is thinking, right? I know that some of you guys might be Chinese scholars, or you are an expert because you can read things in traditional or simplified Mandarin, right? If you have anything to share with me about your views on the Facebook group, do do share me. ICBC, the yield is 8%, you know. Yeah, that's why I bought it. Okay. You notice that I like a lot of dividend stocks, right? When I go overseas. So yeah. So I'm also looking at Altria, looking at Philip Morris, you know, all these kind of stocks, right? How about ADR versus HK listing? Is ADR risky? No, ADR is just a kind of investment, right? So I don't think an ADR introduces any risk, lah. Okay. But I personally, I would rather just go direct to the Hong Kong Stock Exchange, and I buy the China counters. All right. So that's what I would do. Okay. I don't see ADR as introducing more or less risk into the program. Okay. Okay, I guess we're done for the Q&A for the day. And thank you very much for coming to say hi. All right, for members of the public, I hope that you've had fun, and we'll see each other again in December. All right, so in December, we'll have another session like this. You can ask me questions and I'll update you on all the latest weird stuff that I'm doing. Okay, thank you very much, and have a good evening. Goodbye.